Welcome to the Cover Your Assets podcast, a show for the physician who understands the importance of protecting everything you've worked so hard to achieve. If you're ready to find the peace of mind that only financial security can bring, let's get started. Here's your host, Billy Gwaltney.
Welcome to today's episode of the Cover Your Assets podcast. I'm your host, Billy Gwaltney. As always, it's really good to be with you today. In today's episode, we're covering session 3 of the educational series called Cover Your Assets from All Angles. This session is titled Financial Tools and Strategies. It was a popular episode. I hope you find it helpful, and I'm grateful as always for your time. Welcome to the educational series called Cover Your Assets from All Angles. I'm Billy. As you hopefully know, it's good to be with you. I've got Kyle Christensen and John Navin on here again. This is our third part of the 4-part series on this educational financial planning kind of overview. The first session we did a few weeks ago was understanding financial mindsets, introducing Kyle and John and understanding these mindsets. There are 2 types of mindsets, that kind of broad categories, traditional and non-traditional. We went over that, and that'll make more sense as we go here. Session 2 last week, we went over financial goals and personal values, where we just talked about kind of beginning with the end in mind and how that plays a part. That was a good conversation. And today we're going to get into kind of one of the more popular series where people are asking me about financial tools and strategies. Like, hey, what are the strategies? How do I get where I want to go, assuming I know where I want to go? So we're going to cover that today. And then next, we'll wrap it up with risk management and how to make sure that your assets are covered. So anyway, I like that. So Kyle, John, glad y'all are here. I'll let you briefly reintroduce yourself as we go into financial tools and strategies, which is kind of what do you recommend when you understand someone's goals and they're looking at short-term, medium-term, long-term? What do you talk about? Where do you go? John, why don't you start it, being from the traditional approach and side?
Sure.
And just share some of what you discuss with clients and what you recommend and how you do that.
Okay, terrific. Well, great to be here. Good to see you guys again. John Navin. I'm in Nashville, Tennessee. The company is called the Navin Group. Been around 30 years, I think 31 this year. So 31 years going back now. Well, yeah, I guess I basically retired for a couple of years. And I came back and I realized that it's a lot of fun. And this demographic for me is the fun group. I like working now with the younger people. And I feel bad for them because they often don't get good advice, because if you're getting somebody who's less than 40, anybody they're dealing with is typically somebody they knew in college or in grad school. Well, and then they're walking around and all they have is a hammer and everybody's a nail, and they're selling high priced variable annuities and all this other high commission stuff. So now with us being, again, a little bit more seasoned down the road, we've got a few more assets. We don't have to do that. So we can offer some stuff to people that is, again, reasonable, and they'll get good advice, and it's not built around us trying to make a living. So
cool.
It's fun. I'm glad we covered, as you had mentioned, last time we covered figuring out where you're going and how do you get there and what's important to you and what steps do you take. I'm going to start just briefly, and let's just see where this goes, because I don't want to monopolize and run down the wrong street, but let me just tell you how we do it. And in the traditional side, again, we're looking at more so investments that we can hand off to somebody else and they can kind of invest. So I am watching them. I do manage them, but we use something called the bucket approach. And what I mean by that is we have 4 buckets. So we use a cash bucket, we use an income bucket, we use a short-term bucket, and a long-term bucket. I would think most of the people are on here this evening may not need the income bucket yet, which is, for me, the way I use the income bucket, and you're going to hear the exact opposite from Kyle, because it's all going to be about income. I don't think about income at some future point. Now, we plan for future income, and we plan to pull money off of an asset in the future, but I'm not looking to generate income now. We're setting it up to generate income in the future. So cash bucket's going to be anything from like CDs, money markets.
How much cash are you looking when you're talking to the goals? What's the 3 months, 6 months?
Yep. Good question. So cash for me is 0 to 2 years. So if you have something coming up in the next 0 to 2 years, that goes in the cash bucket.
Oh, okay. Got it. All right.
Income bucket, what we do is I'll take a piece of your portfolio. I'll carve out the whole portfolio. We call it a freedom number, or we call it retirement. So most people are talking retirement. If I keep it in that realm, it's a future date, 60 years old. Inside the income bucket, we use a few different vehicles that'll generate an income in the future. So we might use dividend paying stocks. We might use an annuity. We might use real estate or a REIT, something along those lines. Short-term bucket, and typically income, when I talk income, we project out the date that they think they're going to stop. So if we think the freedom number is going to hit at 60, I typically plan to 100. So I'm trying to find some asset or some investment that I can put money into now that will grow to X number of dollars when they're 60. At their 60th birthday, they say, hey, I'm out, I'm going to retire. They'll have some money coming from the portfolio. In a couple of years, 5 years, they may have money coming from Social Security. So that's how we kind of blend the income bucket. Typically income, when people start it, they want it to come in forever. So we set it up forever. And then the short-term bucket is typically money that's 2 to 5 years. Here, I'll use some bonds. We'll do some 60-40 blend with some stocks and bonds. I might use something called institutional money managers, which work a little bit different than mutual funds. And then our long-term bucket is money that is going to be 5 to 7 years or plus. So we don't look at that money I look at it every day. We don't talk about making any changes drastically for 5 to 7 years inside that portfolio. That's going to be stocks, there'll be some bonds, mutual funds, ETFs. That's where you would put commodities. I don't do anything with it. I would put Bitcoin and some of the alternatives in that same bucket. I don't do much of those. We could sell or provide ETFs that have Bitcoin, but that's about it. So we don't do anything with the individual Bitcoin. So that's kind of how we set it up. I'm happy to take any one of those and go deeper.
So you separate, to be clear, I think you said a cash bucket and then a short-term bucket. Those are not the same thing to you.
No.
Right.
So the short-term bucket for me, I'm going to blend a couple different ETFs that are going to be a little bit probably blended more so with either alternatives. And when you talk about alternatives, these are going to be investments that they aren't correlated to the stock market. So it might be a company or different companies that are lending money. It might be some kind of real estate investment trust where a company comes together, buys multiple different office buildings, they pool them together. They look for our investors to contribute to that fund. That fund then pays them back X return after X number of years. Most of that stuff, though, the reason anything that goes in that bucket, I know has never lost money over a 2-year period. So I feel comfortable when people come back, and this is the key, I think, to planning, right? After we figure out what we want to do, what's our purpose, what's our, what do we love, what do we value, then we create a plan and a strategy. And the key behind this strategy, the only thing that changes the strategy is your particular goals. So everything has a time frame in these buckets. We know we're putting money in these buckets for different reasons, and they have a different purpose. So we're not putting it all in one place and going, hey, I hope this all works out. No, we have multiple asset classes, multiple different vehicles. I use bank products, I'll use insurance products, and I'll use the stock market. So I think there's 3 worlds of investing. Those are the 3 worlds, and I think you need all 3 just to serve different purposes.
So say that again. Say those 3 again. I want to make sure. Can you say
I use banks, insurance companies,
like CDs and
stuff
like that?
Money markets, cash, checking accounts, that kind of thing. And then we use the insurance companies. We'll use, if we start getting advanced and really talking about advanced stuff, which I think we're going to talk a little bit more about next week or next time, looking at life insurance, overfunding life insurance. We'll do some of that.
Okay.
Is that
when you say overfunding, you mean permanent?
Yep.
Kind of
permanent
life insurance?
Yeah.
Okay.
Yeah. Okay. So we'll use permanent insurance and then but really I'm after the cash accumulation because I really think the future is going to be a tax play. It's not going to be a return play. You're going to want to position assets to make sure you don't pay tax.
Explain that.
Well, people have a tendency to say, hey, like the 401k. Yeah. So we want to put money in the 401k. I only suggest you go to the match. I think you can go outside the 401k for other reasons. So if the company or the hospital or the organization is matching something, we want to at least put that amount of money in. Another thought or concept.
Do you recommend the pre-tax or the Roth version if they have that? That's pretty common now, I think, right?
Reading my mind, man.
Okay.
Yes. That's what I was just going to say. Do you want to pay tax on the seed, or do you want to pay tax on the harvest? So if you want to pay tax on the seed, then we start looking at Roth, because then it'll be pre-tax. So that's where. So go to the 401k as much as you can to get the match, because nobody's going to give you 100% on your money, right? So make sure you get that. After that, if you can do the Roth, I would go to the Roth, because especially if you're young, that money is all going to grow tax deferred, and it's going to be a ticking tax time bomb, and it's going to be a huge tax time bomb. So what happens is the government says, hey, use this 401k. We'll let you accumulate all this money tax deferred because you'll be in a lower tax bracket. BS. You ain't going to be in a lower tax bracket. You're going to be in a higher tax bracket, because they're going to change the taxes to pay for the debt that we're in, right? So we have to. So you're kicking that can down the road. So, but now I do have a flip side of that. And because we have a 401k, I participate in the 401k. I do both. I do the tax deferred part of the 401k, and I do the Roth portion of the 401k. And I want to use both. I'm planning on using my tax deferred portion as my charitable bucket. I'm going to give it away. So whatever I put in that portion of the 401k, which is probably not what anybody is listening to here, but I know the money that's going in the tax deferred bucket is something I'm going to donate to charity in the future. And so nobody pays tax on it then. So
interesting. Yeah. Do you
but
get
I still get the tax break now then?
Yeah. You get a deduction now. Do you get a deduction when you give it away?
No one pays tax on it though. So if I want to take 100,000 out of my IRA, I can donate it to the charity. The charity gets it, and then nobody pays tax on it. So it's all tax free.
So
I use it as tax block.
I think it's safe to say that a lot of the people listening to this or watching or tuning in are the ones that have signed up, probably in their 30s or 40s on the beginning of their career trajectory as an attending, or maybe in the middle of it. Some obviously could be on the other side. What do they're going to hear, they're making a lot of money or a lot more now. Their taxes are high, and they hear that the 401k is a great way to reduce your taxes now, the shelter pre-tax. So if they have that option and they have the ability to fully fund it, or either pre-tax or post-tax with a Roth, which one would you generally recommend? Or does it depend on the person? I mean, are you going to find out which one they prefer?
It's going to depend on the person. But for example, if they have student loan debt still that they're going to deduct. So we got a deduction there. Maybe we put some more money in the Roth. The other thing is, some of these docs, they're coming out and starting to make money now. Well, the limit I think is like 170,000 this year for a Roth. So if you make more than 170,000, you can't do an individual Roth, but you can do it in your 401k. So we can so I would use the 401k Roth as much as I could and pay the tax now, because we are at historically low tax rates. No one likes to pay tax. So
would you recommend, if they have to pick between pre-tax or post-tax Roth, you would recommend the Roth generally?
I would recommend at least both, but I would lean towards the Roth. Yeah. Because if they make 200,000 now, they're not going to make less in the future. And as that goes and as their money accumulates, they should make more. I mean, it should grow to 500,000, whatever.
So I've heard you talk some about mutual funds in the past and how their fees and the fees and the fees. How can you share about that? Because aren't most 401ks essentially mutual funds?
Inside the 401k, you're still going to have some of those fees, but the employer picks up some of it. There is a great article out. It was out. It's been probably 5-10 years now, but there's basically 28 hidden fees inside of mutual funds that people don't realize. Yes. Kyle didn't even know. That's cool.
28.
No, I know.
That doesn't even sound.
There's a great article. There's a really great article. Just a great article for the listeners. Google, how much do mutual funds really cost? A great article in Forbes that was written by a guy named Kenneth Kim. And he just lists out all this research, that's based on from universities across the country, the Journal of Financial Planning, Morningstar. So all legit resources.
It's a lot. There's much more efficient ways to get to the market. They were great years ago, mutual funds when they first came out, because it was an easy way to get in. We didn't have to have a lot of expertise. But now you can look at ETFs, which are exchange traded funds. You can look at some index funds, and those fees are a heck of a lot less. And you don't get stuck with, all the fees that are inside the prospectus. And then you have, every time they buy and sell a stock inside that mutual fund, there's a fee. Let's say you're going international, there's an exchange rate fee. They don't have to disclose that stuff. They just take it, right? Or if they disclose it, it's hidden in the prospectus and you can't see it. So I too am not a fan of mutual funds. Now,
but if they're in their 401k,
that's all you're going to get. You got to use them, or you have to use an index fund. So I would say make sure you use them, especially you just don't want to miss the company match. You don't, if a company or a hospital is matching 4%, that's free money. It's just take it.
So are you advising people on, and we're going to get to Kyle in a minute, but I'm just I want to, since I'm in this traditional approach. So when you're talking with people and they're socking money away in their 401k, they do the match, and then they say, I have another few hundred or thousand or thousands or whatever it is on a monthly or quarterly, or, I get a true up at a certain point, I get quarterly bonuses, whatever it is, and they get these lump sums. What do you recommend they do? Do you advise them on rental properties or on ways to do other things that are non-correlated? Maybe like
I would say,
or what?
Yeah. And it depends on, again, who they are and where they are. So if we're assuming most people that are on this call now are, just coming out of med school, or they're earlier in their career, let's say they're in their 30s, they're less than 40. Let's just keep it less than 40. Less than 40 and just starting out has a whole different set of circumstances or tools that you would use versus the people who are 40 and above and they got $1 million, right? So I wouldn't use the same things for different people. We might use ETFs and we might use index funds, yes, but you're going to have an insurance component early on in those, I think in those ages, where we've got to make sure we have the insurance protection. You want to make sure you have the emergency fund. These folks are still also saving for a house. They're saving for a boat. They're saving for kids, their college stuff. All those go into a different bucket. So there isn't just one that says, I guess if I'm going to pick one, I would say we do something, and this is going to be probably a little bit more on the 401 or the graduate level course. We use stock portfolios, and they're individual stock portfolios, and what they do is they mirror an ETF. So I will use money managers that pull the individual securities, the individual stocks out of the ETF of the S&P 500 or out of the index. What that does, and here's something else too, when you see an S&P 500 ETF, they don't own all 500 stocks, right? The most I've ever seen is like 310 of the 500 stocks in the S&P 500. The other bad rep that's happening with the S&P 500 now are returns. You look at the S&P 500, it might be made up, most of the return is made up of the top 6 companies. So it's not even the whole S&P. Strategy I'm talking about with stocks, what they do is they pull the stock out, they buy the stock individually. They will trade them every day, every other day, every week. And what it does is it does something called tax loss harvesting, which is another kind of advanced strategy. But they're trying to get your tax basis to 0 in your individual account and provide a return. So we can do that inside that same portfolio.
Clearly, we're drinking from a fire. I mean, this is drinking from a fire hose, or this is a Cliff Notes version. I mean, there's no way we're going to cover all these details in an hour call here. And I got to jump to Kyle because we're going to run out of time if I don't. But so can you name the 5 buckets right quick? Can you, or however many buckets there are? I think you said there were
4 I have cash, income. Okay. Cash, income, short-term, long-term. Those are my 4 buckets.
Got it.
The thing that's important about that is again, it's your time and your goals that drive it. So people don't call me when I explain that and I tell them our process and how it works. They're not calling me when the market's falling. I don't get calls when the market crashes 20% because they know it's in their long-term bucket because we have enough money guaranteed. We have some money over here in cash. We've got our income money taken care of. We don't have to worry about this long-term bucket. It's just noise. So don't look at Reddit. Don't look at all the crap that's out there. It's just noise. Oh, but no, we've got the Putin crisis and we have Russia. I said, yeah, but we had Vietnam. We had World War II. We had World War I. We had There's always something. It's just different.
Interesting. Okay.
Yeah.
So how often are you meeting with them to review all this? Is that
We go quarterly.
coaching quarterly?
Quarterly.
Okay,
It depends. And if they're younger, it might be semi-annually. If they're older, it might be more than quarterly. Proactively connect quarterly. People call us more often than that. So,
okay, got it. Cool. That was good. I'm sure there's some things that we didn't cover. I've got my little cheat sheet here. I think we covered a lot of it. So let's switch to Kyle. Kyle, your non-traditional approach. So take those, whether it's the buckets or however you do this, and talk about the tools and strategies that you're going to be discussing with people as you're talking with them.
Kyle Christensen. I'm the owner, founder of Unique Advantage, which is a principles-based financial planning firm. I'm based in San Antonio. We've got 6 other planners currently nationwide in other areas of the country. I'm the author of Principles-Based Planning, a better approach to financial planning. The question that was brought up is the financial tools and strategies, and I think it's interesting and also a little bit telltale that most financial planners go right to investments and start talking about investing and retirement strategies and so on. So financial planning strategies and tools are, much more than that. We're talking about your income, your taxes, how you do your withholding, how you pay your taxes. All of those things are part of it. Debt management, savings, your saving strategies, insurance, your legal entities, trusts, all of that, including your savings, investing strategies, your charitable giving, all of that is part of financial planning. And that's something that we do. I know John covers all of those bases too, but I think a lot of times when we talk or when people talk about financial planning, they just kind of zero in right away on investing. And I think that's kind of the house on top and maybe even the paint and the decorations. And I think the foundation is all of some of the other things that we were talking about, like your protection and your saving strategies and your debt management, stuff like that. So I'll start with that. As far as tools go, specific tools, obviously, we're gonna talk about every single type of insurance that you either are using or that you should be using, that you should be aware of. Education is a huge part of our process, so we want people to really know what they're doing. Just, a simple thing, like you think about auto insurance and everybody has it or they should have it. If they're driving a car, and how few people really even understand the ins and outs of their auto insurance policy, which should be a given, but it's really not, and so as we go through things, I'll ask people, how did you choose this level of coverage? And usually the answer is, well, it's just what the insurance agent gave me, or I don't really know. It's what I've always had. Answers like that. And quickly they realize there should be better answers to that, right? That people should have better reasoning behind the choices they're making there.
I have a question now, and I really do sincerely.
Oh, yes.
Yeah. What do you recommend? Do you recommend 300, 500, or when you're looking at people's car insurance, what do you see that some of the biggest things they miss are? Or, what are a couple things that we could, because I don't do anything with car insurance. So
it's interesting. I mean, it's definitely part of everybody's financial plan, right? And it's a key part of it. I think the fact that it's required by the state law makes it so that people don't really make an educated decision on it. They kind of check the box, like, okay, the government's making me do this, so I'm going to check the box, right? So as far as the amount of coverage goes, everybody's situation's different. I think, and honestly, every insurance carrier has different limitations or requirements. So for example, I would say that something that's common that I would recommend is that people should have a personal liability umbrella and at least $1 million of liability umbrella coverage. And these doctors that are on this call, the reality is every day you get into a car, you have a target on your back. It's super easy for people to find out that you're a doctor. And if you get in an accident, guess what? You're going to be a target for lawsuit. And if you're not protecting things, if you're not doing all of the investment things as part of your plan. You're not paying as much attention to that as you are your investments. You could be basically building wealth for somebody else that they're going to take away from you. So, it just depends on that client situation. When you get an umbrella policy, just quickly a detail of that, there will be underlying limits of liability that are required on your auto and homeowners policies, and they have to be a certain level. You'd be amazed at how oftentimes I find that they're not at the level they have to be, even though they have the umbrella policy. And guess what becomes the deductible? Guess what becomes the deductible? If you were supposed to have $500,000 limit on your auto insurance and you only have 100,000 and you get in a car accident, you have your $1 million policy, guess what? The $1 million policy will cover you, but you get to pay the 400,000 difference in coverage that you were supposed to have. So that becomes your deductible. So there's a lot of nuances. There's a lot of little pieces of all of these things that go into a financial plan as far as products and strategies go, that, where do you get the education on all of that? It's not part of our formal education system. If you go 20 years in college, you still don't get it. Usually you don't get the financial education. So you're just kind of expected to know what to do. And unfortunately, that usually doesn't happen.
So it sounds like you're including, tomorrow we're going to talk about risk management, right? But you're including this as part of the strategy now for the financial plan, not just something you do for risk. Is that
right? Yep.
You don't distinguish that way. Okay.
Yep. It's all part of a financial plan. So, if we want to jump down to maybe investing strategies and stuff like that, we can talk about that for a little bit. So
Sure.
The financial industry really kind of does one thing and they practice something else. So you think about a 401k just as a simple example, right? So a 401k is the most common financial tool in the United States that people use to try and reach retirement or, to become financially free at some point in time. Think about the rules associated with a 401k. You put money into it, you can't touch it until age 59 and a half. If you do, you're going to get penalized and you're going to be taxed on top of that. If you're employed by that employer still, you can't take out any money except through a loan, which isn't fantastic. I'm sure John would agree with not getting 401k loans.
Yep. I agree.
Yeah. And it's amazing the percentage. John, you may know this, but I think it's somewhere around 30 to 40% of 401ks have a 401k loan against them. And there's a reason for that. It's actually improper planning, I think, that leads to that, unfortunately. So, but think about this. You put your money into something, you get no cash flow. If you're a young doctor, you might be in your late 20s, early 30s. You're talking up to 3 decades possibly where you're not going to touch that money. You're not going to receive any cash flow. And if you do touch it, you're going to be penalized. And in most cases, if you're not working with John or somebody else that's like John, then you probably don't even know where your money's being invested. You're kind of doing it blindly because that's what the common, move is. That's what everybody's doing. All your coworkers are doing that. They're just kind of blindly throwing money into this thing. So you go back to the financial institutions and how they're doing something different than what they're telling us to do. They would love us to do that. They want us to just blindly send them money. And I'm not just talking Wall Street. I'm talking insurance companies. I'm talking banks. They would love us just to send them money, right? Period. Every time we get paid. And they want to hold on to it as long as possible. But what if financial institution put their money into something that they couldn't touch, that wouldn't produce any income to them for decades, maybe 2-3 decades? Would they put their money into something that they didn't really investigate thoroughly and even probably be able to insure themselves with some kind of insurance policy? And I think the answer is obviously no, they wouldn't. And what they really want is cash flow. So they want money to come back to them as quickly as possible. They're not trying to compound interest, even though they can by setting up mortgages, selling us mortgages and other types of loans. They can compound interest. However, they usually don't for very long. They package those up, sell those in a bond, and they get their money back as quickly as possible so that they can do that again and again. So the principle that I teach my clients isn't necessarily, hey, put your money into this account or these funds or this fund or that. In fact, I have zero biased interest in wherever you choose to invest. That's totally fine where you invest, but I'm going to teach you some principles as it relates to investing so that you'll have the best chance of success going forward. But the principle that financial institutions use to create wealth, and they're fantastically good at it for the most part, is the principle of velocity of money. And that's just putting your money into something, getting it back, using it again, putting your money into something, getting it back, using it again. It's kind of I call it the grocery store approach. The grocery store has tons of goods on the shelf. And their goal isn't to sell those goods one time and then they're done. They succeeded, right? That's not what they do. They sell the goods on the shelf. They take a small portion of the profit, then they go buy more and they put them on the shelf again. And they want to do that hundreds of times, thousands of times throughout the year. And essentially they're using that same dollar over and over and over again to generate more and more. And that's what velocity of money is. That's what financial institutions do. So we teach our clients how to do that. A couple major.
What does that look like? How do
Yeah.
how does that individual, I mean, I understand how a bank does it or whatever,
Yep.
or at least a little bit conceptually. How do you do it, or we do it, or a doctor do it?
Well, so that goes back to the first key to that is having control and use of your money. So if you are putting your money into something that you have no control and use, then you lower the velocity, right? You're not getting that money back. So a really great book many of you have probably heard of, you might have read in the past, is The Millionaire Next Door. I'm sure a lot of people have heard of that. Thomas Stanley wrote that book after 25 years of research on millionaires in America. And one of the things that he found out was that only 12% of millionaires at that time credited the stock market for their success, for their wealth building. So that meant 88% relied on something else to create their wealth. And he goes through in detail what that is, especially in the book, The Millionaire Mind, which is the second book that he wrote. But he said they got their wealth from investing in their own practices, in their own businesses, in their own property, in their own ideas. And that's where that wealth comes from. So 88% of millionaires created their wealth that way. That doesn't mean that they didn't have any money in the stock market. In fact, the majority of them do have money in the stock market. But in most cases, that's not where it was created. And so, what I'm encouraging my clients to do is invest in things that they do have control and use of their money. First off, saving, because there's a proper order, in my opinion. So you're saving systematically and automatically, but you're not investing automatically. Automatic means not thinking. It means you're just kind of like when somebody goes to shoot a free throw in a basketball game, if they're automatic, they just go up there and they drain it. They're not thinking about it. Okay. Investing sounds like investigate, and they have the same root word for a reason. And that means because they mean the same thing. They mean learning and investigating. And in fact, the word invest means to cover completely. And I think that's a good description of what that is. So investing should be done in full thought, right? Go ahead.
What kind of strategies or tools would you use for saving? So when you're saving, do you have something similar to the buckets, or do you do like a quadrant kind of thing, or do this first, this second, this third, or how does that work?
So saving should be in something that actually is saving. And so we have three characteristics that define what that is. One is that it should be liquid. Second one is that it should be accessible. And third one is that it should be guaranteed. So liquid, guaranteed, accessible. Now, the word save means to remove from risk. Okay. To eliminate loss, right? And reduce that risk of loss. So that's what saving is. And if we apply those three characteristics, we can kind of identify in the United States, what are the options? Because it's not unlimited. Essentially, it's bank products, right? Certain bank products. So checking accounts, savings, money market accounts, CDs, those all would count. And then cash value of life insurance could be an option as well. Outside of that, there really isn't another liquid, guaranteed, accessible option. So that's what saving would look like, right? And that should be done systematically and automatically. And there's a really great book by Mike Michalowicz called Profit First. He talks about how, the formula for profit is wrong. He says that gross revenue minus expenses equals profit is a lot of the reason why people fail financially, that own businesses, because the profit's the afterthought. So think about that from a personal standpoint. If you make money and then you pay all your bills and then what's left is what you get to keep, what's going to be left? Not much, right? It's a poor strategy. Most people know that, hey, I want to pay myself first, but most people don't do it, right? So that's the difference. So we want to set it up so that it's actually happening. And we're making that super important decision of paying yourself first and choosing a percentage of your income that you're going to keep.
Go ahead, John.
So I love your reference to A Millionaire Next Door. I think that's cool. And the only thing I want to add is that, and it's a great book, Billy, if you haven't read it, or if anybody else hasn't read it, it really is. It's been around for a long time, but good book. But I think there was something hidden in there that Kyle said that's very, very important. Because the other thing is it's living below your means. Most of the people in that book, do you know what the average millionaire drives? What kind of car?
I bet it's paid for or whatever it is.
It's paid for pickup truck. Do you know what their favorite drink is? Beer.
Water.
So they had hosted all these people.
Say water.
Well, maybe it was water, but no, they are not. People think that the millionaires are the ones that are spending all the money and they're all falutin in their dollar bills. No, these are the conservative Texan pickup driving. I drink Diet Pepsi, and no, we don't spend our money, right? We put it in stuff that we care about, and we're not going to just throw it around. That's how you become a millionaire. So doing the stuff that Kyle says, doing the stuff that we talk about, and living below your means and saving your money, that's how you become a millionaire.
Kyle, when someone says, hey, I want a better return than what I can get at the bank or in cash value or whatever, I don't want to just save money. I want to grow it. I want to expand it. And it seems to me to make sense to do the 401k, put it in the market. I don't know what else to do other than, I guess you could buy a McDonald's or something, but that seems complicated. So when you're recommending, what kind of strategies do you use when someone's saying, hey, I got the savings part, I got 50 or 100,000 in the bank. So what do I do now? Kind of thing.
Yeah. So you guys are going to get tired of me saying this because it'll sound like a broken record, but it's principles that drive your behavior, or they should, right? In most part of your life. And I mean, these medical professionals, they have principles that they follow. They're not just reinventing the wheel every time they do a surgery or whatever, right?
Yeah, that's a good point.
They're following principles. And the value of principles is that it's like a recipe. Ray Dalio talks about this in his book titled Principles, Life and Work. He says that principles are like recipes, and the reason they're like recipes is because you can follow them and you get similar results almost every time, right? And you can apply those over and over again. So when it comes to investing, and first off, people absolutely have to get a better rate of return than they will in their savings, in their liquidity, right? If they ever want to be financially free. You couldn't save enough money to become financially free in those places. So all of the ones we mentioned, yeah, they're great for saving, but they're not the end goal. That's not where the money sits and you leave it there and then someday you're going to be financially free. So somebody has to do something with it. And so I think you have to have a criteria for where you're going to invest. I think this is a big difference between me and the traditional planning approach, is because I don't believe that people should be dollar cost averaging, which is automatically investing, right? I don't think that people should be doing that. I think people should be evaluating every investment on their own merit, and then they should have a criteria. So Warren Buffett says the difference between successful people and highly successful people is that highly successful people say no to almost everything. Well, how do they say no? They have to have a criteria. When you got married, Billy, did you have a criteria of the type of person you wanted to marry?
Yeah, don't start putting me on the spot here. This is
I'm
I
saying
ain't
this because
touching
I
that.
know who Billy's wife is. I know who Billy's wife is, and she is awesome, right?
She is really
and
cool.
and
Yes.
and
I
Billy,
outkicked my coverage. I had a
yeah,
criteria, but she
she was better than that.
blew that.
And
Right. That's right. That's
and
right.
the
Yeah.
biggest, the most lucky thing that happened in Billy's life is that she said yes. So you have to go into investing having a criteria. So the basic criteria that we give our clients, that we encourage our clients to adopt, is the 3 rules for investing. So rule number 1 is invest in what you know. And that can mean 2 things, and usually does mean 2 things. 1, it could mean that you invest in the things that you're already kind of an expert in. You know, if you're in the dental field, for example, and you're a dentist and you're working on people every day, and you notice, hey, there's some kind of issue with this. I don't really like how this software works. I don't like how this machine works. I would like this or that to change. Well, guess what? Most of the inventions that are going to occur in the medical, dental industry, et cetera, guess what they're going to be coming from? Who's giving them the ideas? It's coming from those doctors. They're the ones that are dealing with that. So those are multi-million-dollar ideas that people are going to have. And in the next 10 years, there's going to be a ton of them, right? And why couldn't any of you who listen on this call, why couldn't you be the one that comes up with something? So invest in what you know could mean invest in the expertise you already have, and you just expand that. Another meaning behind invest in what you know is actually invest in your learning, right? Like if you want to become a real estate investor, for example, the first investment you should make is not to go buy a condo, right? Your first investment should be in learning, right? So you read about it, or you listen to podcasts, or you have a mentorship program that you join. I mean, think of the value of mentors in your profession, how important that has been for anybody who's been successful in any profession. I think mentorship is huge, right? So that's what the first rule is: invest in what you know. Second rule is invest in what you can control. There's a huge range of control, right? There's 0 and there's 100%. And I would say that no investment has 100% control of the outcome. Even if you own your own business or you own your own property, you're never going to be 100% in control of the outcome, but you can be a heck of a lot more than 0. And that's what I encourage. The less control you have, the less you know about that thing. What happens to risk? It goes up. Your risk of loss goes up. The less you know, the less you have control and influence over the outcome. Number 3 is don't chase returns. So many people only follow the deciding factor for them writing the check to put into something was that somebody told them they're going to get a certain rate of return over time, whether that's in the stock market or whether that's in real estate or a franchise or anything, right? If you're investing in something and the only thing you really know about it is the projected historical expected rate of return, then you're chasing returns. And typically that leads to loss because, it's funny because Money Magazine, which I don't even know if it exists anymore. Does it, John? Might be online or
I
something at
don't
this point.
know. It was funny you say that, and I know where you're heading. So I won't.
Yeah.
I don't know if it's
So-
around or not anymore. I was in
So-
it 20 years ago. I'll tell you
Yeah,
that.
for a long time.
Small claim to fame.
Yeah, so for a long time, Money Magazine used to produce their hot funds, the top picks, whatever. And they actually did a research study on Money Magazine's picks, and they actually found that the opposite of what they had stated was actually what performed well. Because what Money Magazine was looking at was what did well last year. And so if you always do what did well last year, if you try and put your money into those things, it's a has-been. And the chances of that repeating were almost 0. And so that's what people a lot of times do in their 401ks and stuff like that. When they're choosing their funds, they're looking at average rates of return over a period of time. And they're not choosing the one that did the worst last year and putting all their money in there. They're choosing the one that did the best last year. And typically that leads to loss. And there's actually quite a few investor return study that support that.
I'll chime in with that one too, Billy,
Yep,
because
go ahead,
even
yeah.
coming from the traditional side, I agree 100%. You cannot chase returns and you can't go by because that same article, they quit producing it because none of them were duplicating the second year, right? So they had the top 20 mutual funds for, the year 2000. Well, none of them were on in 2001 and half of them were bankrupt. So you've got to spread the money out and it can't be in the same place.
So
yeah.
a question, I had a question even today with a client who was emailing me, asking me about, and she had signed up for to be here. I'm not sure if she's on or not, but she was asking about, hey, do you know anybody? Can you help me with that, or that anyone that can help me with student loan repayment? And I know I get that question a good bit. I mean, even on the disability side, when I'm talking to physicians about their insurance, some companies have a student loan repayment rider that you can add to the policy for about a 10% charge or a fee to it. Some will take that. I mean, that's attractive to them because their student loans are a really serious kind of albatross around them, especially when they become an attending. So when someone wants to get rid of student loan debt and then also needs to, the 10 years or 5 years or 15, however long it takes to do that, they've also got to save for these other things that they're wanting to do that have been pent up for a long time, right? Because they've been in training for so long. Any thoughts or wisdom on strategies for how to tackle that? Whichever one of you wants to jump in.
Go ahead, Cal.
Okay. Yeah, no problem. Yeah, I mean, it's obviously this epidemic, really. We've done a fantastic job in our country, effective job of promoting college education. And college education has gone up tremendously in cost. And, the value of like a bachelor's degree, for example, has actually decreased over time because there's more and more people with bachelor's degrees. If you graduated with a bachelor's degree in 1985, then you had a job. Like there weren't very many people in the country that had a bachelor's degree comparatively. And now that's not the case as much. So yes, we've got this huge debt burden that most people are finishing their school with, especially doctors. And it's huge. And, there's been a ton of conversation in the political realm about changing those things and forgiving debt and all kinds of stuff like that. So the reality is if anybody tells you that they know what's going to happen in the next 5 years, they're lying. They don't have a clue.
Right.
I mean, the reality is it could become a public thing in not too long. In 10 years, it could be public. Could be just like Italy, could be just like Germany, where it's paid for by
what do you mean
by taxes.
to be public?
Could be paid for
student loans are going to be paid for by the
no. I'm
public?
just saying education in general. And
Yeah.
then if that occurs, certainly there will be clamor from people who have mounds of student loan debt that had to pay for it, but now it's being subsidized, being managed by the government. It's going to change. That's what I will say, is that student loans and how it's being paid, how school's being paid, how student loans are being paid, that's all going to change. That's one thing I can guarantee you. The other thing I can guarantee you is that if you prepay your student loans, like you want to be a good citizen, you just want to get rid of your loan, that money you will never see again. You're not going to get that money back. Any extra money you pay on those student loans you're not going to get it back. I'm not telling you not to do it. I'm just saying that that's going to be the case, that they're not going to send it back to you if they change things, if they forgive a bunch of debt. And you may all say, well, I'm going to be making so much money, they're not going to forgive mine. I wouldn't bet that. I wouldn't bet on that's going to be the case. The income driven repayment plans on student loans actually are not designed for the most part to pay off the debt. They're designed for a certain number of payments, and then whatever remains is forgiven after the certain number of payments is met. The SAVE program, which was the current administration's kind of workaround from forgiving huge amounts of student loan debt, is really interesting. It was designed to be the best repayment plan out of all of them. Because what used to happen is you would have the principal bucket on the debt, on the student loan, and you had the interest bucket on the student loan. And if you were on an income driven repayment plan and your payment, which was calculated based on your income, et cetera, wasn't enough to even cover the interest, which in most cases it wasn't, then that difference in interest that you didn't pay would just be added to an interest bucket. Okay. So that was money you would have to pay off first before you even touch the principal on repayment. Okay. Well, Save came in and changed that. So now the interest that, let's say your monthly payment that they calculate doesn't even cover all the interest, that difference gets forgiven every year. So each year it's that difference. So it's not accruing in an interest bucket. There's a lot of different things that we could talk about here, but as far as strategy or the situation, I would say that very few financial planners in the country know very much at all about student loans. It's just not an area that they get paid in. So they're not very
when you say student
incentivized.
loans, are you lumping medical school debt into the same category
Absolutely.
as someone who got a 4-year bachelor's degree kind of thing? Because the
Absolutely.
numbers seem to be a lot higher for medical school.
For
Like,
sure.
We're talking
Yep.
the 400,000 or 500,000 they may have when they come out.
Right.
So you're talking about this in the same category as that.
Yep,
Yeah.
that's right.
Okay.
Now,
Yep.
now the one plus is student loan is still tax deductible. So you still can. Now, I'm assuming it is. I have not seen anybody with a $500,000 student loan. So I can't speak to a number that high, but for the most part, the debt is tax deductible. So you want to pay it off, I would say, and pay the schedule. But if you had extra money, I would agree with Kyle. I'd put that somewhere else. I'd put that money in the market, or I'd put it in your
So
savings
it
account.
sounds like what you're saying is if you can figure out a way to not overpay it and wait and see what happens, you might find that you don't have to pay anything.
Well, no,
Or
see,
you
now
might pay a lot less. Yeah.
A lot
I
less.
totally
Okay.
disagree with that too, because I think that's going to turn into and we aren't going to debate student loan debt here, but if they start forgiving student loans, where do they stop? And not only that, I took out the loan, right? So I owe it. I made a conscious decision. So for me, it becomes a little bit of an ethical thing, but I'm sure I'm not making any friends now, right? So I still, if someone's going to give you free money, shut up.
No,
John,
I'm
right?
with you. I'm with you, but I would just say there's a lot of that happening.
I know. There's
a lot of that kind of stuff happening.
Yeah.
So
I haven't dipped in it. So my thought is, if you borrowed it, it goes back to Beretta. You guys
I
know
get that.
him,
I
right?
think that it's just that, when they become an attending, they want it. There's like a 10-year schedule or a 15-year schedule where that's like a big, someone's income jumps up, but a big chunk of that is going to pay down the debt. And then,
But they're investing in themselves, those two, right? Just like Kyle talked about, it's intellectual capital.
It's kind of a
We
cost
already
of
got the
business.
credit
Yeah.
for it, right?
Yeah.
Now we just got, but think about it in 10 years. I mean, I know it sucks, right? So we're going to have to pay this thing for 10 years. 10 years, you got $100,000 a year raise or $50,000 a year raise that now you can start putting back into.
That's a good point.
Into something.
Interesting.
So you just got to be a little bit more patient, I think, is what I would suggest.
Cool. Kyle, do you, or both of you seem, so the reason I'm glad you're both here, I think you both have kind of a coaching approach to how you do it, or a teaching approach, education. I agree. Obviously, Kyle, yours is highly educational, and it requires, it's like you give homework assignments, right? So, I mean, there's stuff you're going to have to have some, what do they call it? Sweat equity or whatever in what you're doing. And I think yours, John, seems to be obviously on the traditional side, but I get the sense that you're making sure people understand what they have and are evaluating it frequently so that they remember why they did what they did.
And the whole key is understanding, just like Kyle said, it's investing in what you know. And I've always said, if you can't explain it on a napkin, you shouldn't be investing in it. If you can't understand it that simply and easily, you shouldn't be investing in it. But he's right. Most of the industry on my side walks around with that hammer, and they're just looking to sell somebody something. We don't do that. Kyle doesn't do it. It's more about educating them on what their pros and cons are. If you pick this investment, we got to be aware of this. If this is the negative, this is the positive. You're going to get them both with every single thing you pick. Even if you pick real estate or a car wash, there's going to be a pro and a con, right? just the way they are.
Well, and that's the thing. We'll talk about risk management next time because I think that's we touched on it with the umbrella and the car insurance stuff, but also, as you talk about life insurance and protection, disability insurance obviously fits in that. Everyone on here, at least that I invited on here, has that part covered and covered well. But I do think that it's interesting how all these things tie together and how I think one of the key takeaways for clients I hope they're getting is that you're going to have to invest, and it's kind of an ongoing conversation. You're going to have to invest some time and some energy into understanding what you're doing, because it's you, Dr. Smith Incorporated. You are an entity. Every day you show up as a today I talked to electrophysiologist, interventional cardiologist, which is different, gastroenterologist, trauma surgeon. I'm talking to these people and I'm going, the level of specialty that they bring to the table is stunning to me. Like if you're an electrophysiologist, or if you're just the amount of training they've gone into, if you're right, they did invest in themselves, but just thinking about how to make sure that they're taking care of that, and not only from a protection standpoint, but how they invest the resources that come about as a result of this asset are just it's a big deal. And it scares me when I think of the average financial advisor or planner or whatever that I've seen over the last 3 decades that may not be in the business in 3 or 4 years, or going to be somewhere else, or they work somewhere where they don't have any control. They're at a bank, and the bank owns the assets. The bank owns the client. The bank owns everything. They don't really have much of anything they're going to do what their manager tells them to do. Anyway, all these kind of things, it just scares me. It's one of those things, which is why I wanted to put this together. Okay, Kyle,
yep,
thank you
great.
both. I really appreciate it. This was really good.
Thank you.
And we'll finish up session 4 on the risk management. Thanks for joining us. That's it for today. Hope you found this helpful. The next episode will be the final session 4 of the educational series. The title is Traditional versus Principles-Based Approach to Risk Management, How to Protect What You Get. Tune in here. We'll release this soon. In the meantime, please feel free to reach out to me anytime with questions or any way I can help. 704-270-2376. You can text me. Again, 704-270-2376. Thank you, as always, for your time.
Thanks for listening to the Cover Your Assets podcast, a Work P2P production. New episodes drop every 2 weeks. If you've enjoyed the conversation, subscribe, rate, and review this podcast. For more tips and advice, visit the website and YouTube channel. Check the show notes for links. Join us next time for another episode dedicated to helping physicians like you get your disability insurance right and protect your way of life.